Hey guys, in this video, I'm going to give you both a high-level and low-level breakdown of one of the most popular all-in-one ETFs for Canadians, XEQT. If you want global equity exposure, no fuss, one ticker, this fund even gets pitched as the set it and forget it fund. However, today we get under the hood. What's in it, how it behaves, what to love, and what to watch out for. And if you care, why I own it. Let's do this! If you're new to the channel, I'm Mr. Financial with over 100,000 followers on Blossom Social. I'm into evidence-based investing using empirical data and studies. If that's your vibe, hit that subscribe button. I'd love to have you here with me. In my last portfolio update, I share how I made the switch from dividend growth stocks to broad-based index ETFs in my TFSA. You can check out that video here. As of right now, I own 7 broad-based ETFs and my largest position is XEQT. You got that right. Let's now get a high-level overview. What exactly is XEQT? It is iShares Core Equity ETF Portfolio, also known as an all-in-one ETF. XEQT is like the entire stock market smoothie of ETFs. It has an asset allocation of 100% equities. And that means 100% exposure to stocks. And that's why this fund may grow fast, but also drop fast too. It's a roller coaster, but a well-designed one. It is also a fund of funds, meaning that it holds other iShares equity ETFs, giving it exposure to 8,446 stocks. It automatically rebalances for you. It trades on the TSX and CAD. It was launched in 2019, so it has a little bit of a track record, and it has $11.8 billion in net assets. Pretty impressive for a fund that's only 6.5 years old, right? XEQT has an MER, or a management expense ratio, of 0.20% and is considered medium risk, looking at it through the lens of volatility. All this information is found right on the main page of XEQT. It's really basic and requires absolutely no digging. But that's not enough to make a decision as to whether this ETF belongs in your portfolio or not, wouldn't you agree? So now let's look under the hood and do a low-level deep dive, but not too deep. You sleep deep dive. But I gotta say, I love the nerdy stuff. It's my favorite part of looking under the hood of how an ETF is constructed and how it's held up over the years. So I mentioned XEQT is a fund of funds, and all these funds are passive indices, meaning management doesn't pick the individual stocks. Rather, they pick the ETFs, which hold a basket of stocks representing certain specific markets. XEQT's 5 ETF holdings are XIC, iShares S&P TSX Capped Composite Index ETF, XEF, iShares MSCI EAFE IMI Index ETF, XTOT and ITOT, iShares Core S&P Total US Stock Market Index ETF. Man, that's a mouthful. They need to find a way to shorten that. And XEC, iShares MSCI Emerging Markets IMI Index ETF. It's those ETFs that give XEQT exposure to 8,446 stocks. The top 10 underlying holdings are similar to the S&P 500, but only make up 17.4% of the fund, giving it a lot less concentration risk. By contrast, the top 3 stocks in the S&P 500 make up over 21% of the index. And XEQT includes 3 Canadian companies in its top 10, Royal Bank, Shopify, and Toronto Dominion. Why is this the case? Well, this brings us to the target weightings of the fund, a key component of what makes a fund diversified or not. XEQT behaves almost like a global market tracker, with a bit of a tilt towards the US because that's where the global market cap is the highest, at about 63% of the world market capitalization. XEQT uses a blended reference index, which is a composite of the S&P TSX capped composite index, I hope I said that right, 25%. The S&P Total US Market Index, 45%. The MSCI EAFE IMI Index, 25%. And the MSCI Emerging Markets IMI, 5%. That reference index is also the target weightings for Canadian, US, international developed, and emerging market equities. You will have noticed the exposure to Canada is very high at 25%, compared to its market cap weight in the world market at only 3%. XEQT is designed specifically for this home country bias. Many studies have been done on what is an appropriate level of home country bias and the pros and cons of it. I'll be covering that in a completely different video. Of course, the world market indices do not all appreciate or depreciate equally. So this is where the automatic rebalancing of an all-in-one fund is so awesome. According to the prospectus, XEQT can, at their discretion, change the target weighting of the fund. This is normal and should not be of any type of concern. XEQT, as it currently stands, aims to not let the target weightings deviate by more than 1/10. So for the S&P Total US Market Index, that would imply a 4.5% swing in either direction because of its 45% target weighting. Or for the S&P TSX Cap Composite Index, 2.5% swing in either direction because of its 25% target weight. Now this rebalancing comes at a cost. I know we already spoke of the MER, the management expense ratio, being 0.20%. There is another expense one needs to think about when buying an ETF. It's TER, or trading expense ratio. XEQT is very cheap with a TER last year of only 0.01%, bringing the total cost of the fund to just 0.21%. Quick thing, guys, before we continue. As you've probably seen on socials, there's a lot of misinformation when it comes to finances. And mainly it's because the algorithm pushes content that gets lots of engagement. My goal is to always provide accurate information, no matter how boring it may be sometimes. So if you've been enjoying my content and hopefully learned something new, please let YouTube know by liking, commenting, and sharing this video with someone. Thank you so much for supporting the channel. Now back to the video. So with that target weighting, how does XEQT look geographically at present? It is, of course, the heaviest in the US and Canada at 43% and 26% respectively. Then comes the EAFE countries, Japan at 6%, the UK at 3%, and France at 2.5%. Part of XEQT's charm, if I can call it that, is how the sector exposure gets a nice rebalancing by leaning away from the US market, which is very tech heavy. This is what it looks like. And did you notice how tech is still the highest, but at only 21% of the fund, while financial services and industrials round out the top three. Real estate, which is under a ton of pressure here in Canada and the US, only makes up 2.3% of the fund. This brings me to the style of XEQT. It is a blended large cap fund with 33% of the fund as such and 23% large cap value with only 19% in large cap growth. If you compare this to, say, the NASDAQ 100 QQQ ETF, 79% of the fund is between blended and growth with only 11% value. So no, XEQT is not a growth fund by definition. It is a blended fund. After looking into the fund a little deeper, you're likely thinking, performance, Mr. Financial. It's all about the performance. Okay, let's talk performance because I know that's what you guys love. But I'm going to do things a little differently because we only have about 6.5 years of data to look at. Now, using the most recent data from iShares, which is as of November 30th, 2025, since inception, XEQT has a 13.91% average annual return. Its 5-year return is 13.98%, nearly identical. And as you can see from the 1 and 3-year returns, they're ridiculous at nearly 20%. That's just how good the markets have been lately. And now looking at the factor profile of XEQT over the last 5 years, you'll notice it's pretty neutral with the exception to the momentum factor, sitting at the top of that range. It is also a little low on the liquidity. Now, the liquidity factor describes the trading frequency of a fund based on its trailing 30-day share turnover. The higher the exposure to the liquidity factor, the higher the share turnover is. This, of course, has its pros and cons. Now, included in those total return numbers we're just speaking of is the small 1 to 2% distribution yield that's been paid out over the years. Now, be sure to understand the tax repercussions for holding XEQT in a taxable account. Don't get this wrong. XEQT is 100% exposed to stocks, so it hasn't gone up in a straight line as the numbers may suggest. That negative 10.93% return in 2022 is what being 100% equities looks like. Don't be fooled. This is not a conservative ETF. Don't let the all-in-one label or the medium risk fool you into thinking it's safe. Now I'll add some color to this performance before we talk about the risk in a little more detail. This is a snapshot from the management's report on the fund's performance at the end of 2024. That's something you may want to peruse before jumping into any ETF. You'll notice the TSX Capped Composite Index performance was a little less, and the MSCI ACWI X Canada IMI was a little better performing. This makes sense given XEQT's 25% Canadian exposure. How would this fund have performed over a longer period of time though? Say the last 10 years? Thank you for asking. Thanks to our free little tool, Portfolio Visualizer, I recreated XEQT and got 10 years of data using a backtest. For disclosure, the fee structure is of course different now, and there is no rebalancing happening over those 10 years. I also set the benchmark as the MSCI ACWI World Index ETF, similar to what I'm using for my portfolio. Here are some of the standout results. It had an average return of 12%, no alpha, and a maximum drawdown of 17.7%, much less than the benchmarks because of less US exposure. It had a lower standard deviation, another word for volatility, and a better worst year, but a worse best year. A little confusing. It had a slight edge on its Sharpe ratio, which is another risk measurement. The higher the better for the risk you're taking on. When looking at individual returns of each component of XEQT, you'll see how the diversification smoothed out the returns. When one part of the market is struggling, others are excelling. That's kind of a nice way to segue into the risk profile of XEQT. This is the part I think you'll want to especially pay attention to if you are a risk-averse investor or are just near retirement or in retirement. So I mentioned iShares has this fund labeled as medium risk. And as we saw, it can have quite the yearly swings up and down. Let's look at some of the risk measurements using Morningstar's portfolio risk score. Again, this isn't to be taken as the end-all be-all for risk KPIs, but it gives us an idea. Morningstar rates this as an aggressive fund, nearly very aggressive to put it into perspective. It has a high return compared to its category with the same amount of risk. The beta is 0.98, which is a little misleading. I'll get back to that in a second. It has a great R squared, meaning its beta is pretty strongly correlated to its benchmark. Its Sharpe ratio is 1, the higher the better, showing a decent return for the risk. And its standard deviation is 11.15, much below the category average. That's good. Now let's get back to the beta. When it comes to beta, or how much a stock price can swing up and down, it's good to get the full picture. Now here you can see XEQT captures only 99% of the upside, but compared to the downside, it was only 95%, which is great, meaning it's protecting the downside somewhat and basically getting all of the upside. So that lower beta is skewed to the downside. That's what you would want to see. And lastly, let's look at the price to earnings of XEQT to get an idea of the value here. It's currently sitting at 17.7, which is on the higher side of things for the fund in comparison to the total US market, which is sitting at 21.6. XEQT is reasonable. Again, this is what having 55% exposure to the ex-US market does. So let's review the review. That sounds so ridiculous. XEQT is an all-in-one ETF with 100% exposure to stocks through 5 ETFs with 8,446 underlying stocks to be precise. Its market allocation is 45% US, 25% Canadian, 25% developed markets, and 5% emerging markets. Fees do matter, and this is where XEQT shines. You're only paying 0.21% for a global multi-ETF portfolio that rebalances itself. So who may this fund be good for? Someone who is looking for a simple yet beautiful and efficient portfolio. Asset allocation ETFs give investors a way to build a portfolio in one simple ticker. XEQT gives one diversification across the world market, and it's continually monitored and rebalanced as needed. Now this is very important, and I cannot stress it enough in this video. XEQT is 100% stocks, so it has higher volatility and larger drawdowns, which make it not suitable for someone who freaks out or loses their cool on a 10% dip. War, inflation, currency swings, it will all impact XEQT. This has the potential for over 50% drawdowns like the MSCI ACWI IMI index has had in the past. And it does have a heavy US exposure. It's not a bad thing, it's just the reality of the current global market cap weight. Some people think all-in-one means equally weighted across the world. It does not. This also has overexposure to Canada, a clear home country bias. So in my opinion, XEQT is great for long-term investors, which means a time horizon of 10 or more years. It's great for passive investors who don't want complexity. It's great for global diversification with zero maintenance. It's great for investors comfortable with exposure to, yes, 100% stocks. And it's great for a core holding to build a portfolio off of and combine with other ETFs, or as a stand-alone portfolio. And in my opinion, XEQT may not be for you if you are a conservative investor, if you want tactical control of your portfolio, if you want control of the fees of your portfolio, more control, and if you don't want Canadian home country bias. I personally hold XEQT as a core position to simplify 2/5 of my portfolio. This gives me the other 3/5 of my portfolio to tilt it as I see fit. So that's my full breakdown of XEQT, one of the easiest ways for Canadians to build a globally diversified 100% equity, yes, 100% stock portfolio with just one ticker. The same could be said for VEQT, ZEQT, FEQT, TEQT, and so on. I'll be reviewing the other 6 ETFs I own in my new revamped portfolio over the coming months, so stay tuned for that. If you're completely new to investing and don't really know what ETFs are, the pros and cons, you should check out this video right here. See you there.